Quiet summer month, you wish. At the beginning of August, markets tumbled. Felix Brill, the Chief Investment Officer of VP Bank, will explain what happened. Felix, what were the ingredients for the recent setback in equity markets?
Well, there were many. For instance, we've seen a weaker job market report in the US. We've seen the Bank of Japan hiking interest rates. We've seen profit-taking with some of the tech companies after the earning results. And we've seen on top also the Middle East with Iran, the situation in Israel. And probably there was even more. That's with any good dish, basically. You don't taste all the ingredients directly. But here's the thing. I don't think that was a good dish because the ingredients, they didn't match and became away with a stomach bug, I would say.
Already some are saying the US central bank should lower interest rates dramatically. How does the current situation compare with previous events?
That's a common pattern, isn't it? So when things go well, no one wants to know anything about interventions, but if things turn out a bit more tougher, then everyone calls for help. This time around again, the Fed should come to the rescue. But in this situation, I think it's very important sometimes to take a step back, to look at things. And if we do that, we see, yes, of course, economic data has not been great recently, but maybe expectations have been a bit too high. Maybe that has been the healthy correction we needed. We don't know it yet, but I'm not sure if emergency rate cuts by the Fed would really calm the situation, that they could rather provoke a bit of a sense of panic, like it did in 2001 in the internet.com bubble, or in 2008 when the global financial crisis kind of took hold of the global economy.
Japan and its currency, the yen, were at the center of this episode. Why did the appreciation of the yen have such dramatic effects?
Well, it's been a bit like with a rubber band. You can stretch it, you stretch it a bit more, stretch it even further, until at some point it snaps, right? And this was kind of the case. The Japanese yen has been depreciating for many years now, so the rubber band has been stretched. Partly because of the so-called carry trades, where you borrow money at low-yielding currencies like the yen for cheap and invest it in high-yielding currencies like the US dollar. And that is great as long as the yen is not appreciating. But if it turns, then usually because the rubber band has snapped. And this was the case, and that hurts. And we've seen what happened in the recent days.
What happens next, and what does this mean for clients' portfolios?
If you just knew, the thing here is it's very difficult to predict market sentiment. It's just how it is, and we take that seriously. So we don't put all our eggs in one basket, but rather try to always diversify well. That might change over time. For instance, we decided end of last year to stop hedging the yen with our Japanese stocks exposure. So that helped in the current situation to cushion the drop in Japanese equities because the yen appreciated, right? We continue to do that, and on top of it, we are basically fully invested, but very well diversified with just some small adjustments, for instance, with Swiss government bonds and high-yield bonds in the US.
Thank you, Felix. And that concludes our View the Questions. I hope you join us again next time. Goodbye.